The United States is standing on a financial fault line, and the cracks are widening. With national debt surpassing $35 trillion and no political appetite to rein it in, America's fiscal situation looks less like a temporary imbalance and more like a ticking time bomb. Rising Treasury yields, dependence on foreign creditors, and structural deficits make the problem worse, while both political parties continue to look the other way. Unless addressed, the consequences could reshape the global economy. No political will to reduce debt. One of the biggest factors fueling America's debt crisis is simple neglect. Neither Democrats nor Republicans have taken meaningful steps to cut spending or raise revenue. Instead, Washington has fallen into a cycle of temporary fixes, debt ceiling extensions, stopgap budgets, and partisan blame games. Entitlement programs like Social Security and Medicare continue to expand without sustainable funding, while defense spending and interest payments swallow ever larger portions of the federal budget. The lack of political courage has effectively kicked the can down the road for decades. But now, with interest costs exploding, that road is rapidly narrowing. Rising Treasury yields, the silent killer. For years, low interest rates masked the true scale of America's borrowing problem. The Federal Reserve's near-zero-rate policies after the 2008 crisis made it cheap to borrow, encouraging lawmakers to rack up more debt with little immediate pain. But that era is over. Today, Treasury yields have surged above 4%, 5%, meaning the U.S. must pay dramatically more to finance its obligations. Interest payments alone are projected to exceed $1 trillion annually, soon becoming the single largest line item in the federal budget, bigger than defense, Medicare, or Social Security. Why yields may keep rising even if the Fed cuts rates. Conventional wisdom says that if the Fed cuts rates, Treasury yields will fall. But the debt dynamics today are different. Even with lower policy rates, yields could remain elevated, or even rise, because of three powerful forces. 1. Supply flooding the market. The U.S. must issue massive amounts of new debt just to cover existing obligations. With trillions in treasuries rolling over, investors are demanding higher returns to absorb the flood of supply. 2. Investor confidence. Concerns about long-term U.S. fiscal discipline are forcing bondholders to price in more risk, keeping yields higher regardless of Fed policy. 3. Inflation expectations. Even if rates are cut, fears of sticky inflation or future money printing to cover deficits could push investors to demand higher yields. In other words, the Fed no longer controls the bond market the way it once did. Market dynamics, not just monetary policy, are driving yields upward. The fragile relationship with foreign creditors. Another overlooked risk is America's dependence on foreign buyers of its debt. China and Japan remain two of the largest holders of U.S. treasuries, collectively owning over $2 trillion. While treasuries are still seen as the world's safest asset, geopolitical tensions are straining this relationship. China, in particular, has reduced its treasury holdings in recent years as U.S.-China relations sour over trade, technology, and Taiwan. If foreign demand for treasuries declines further, the U.S. will be forced to rely more heavily on domestic buyers and the Federal Reserve, which could destabilize both the bond market and the dollar's status as the global reserve currency. The dollar's reserve status under threat. For decades, the U.S. has enjoyed an exorbitant privilege. The dollar's dominance in global trade and finance allowed America to borrow cheaply and run massive deficits without immediate consequences. But cracks are emerging in this system. Nations from China to Saudi Arabia are exploring alternatives to the dollar in trade settlements. While the dollar still commands overwhelming dominance, even a gradual erosion of its role could make U.S. borrowing significantly more expensive. A weaker dollar would also drive inflation higher, creating further strain on American households. An unsustainable path. Taken together, these factors, political gridlock, rising yields despite Fed cuts, dependence on foreign creditors, and potential threats to the dollar, paint a bleak picture. The U.S. debt is no longer a distant problem for future generations, it is a present danger. If nothing changes, America risks entering a debt spiral where interest costs outpace economic growth, leading to painful choices: slashing essential programs, drastically raising taxes, or inflating away the debt by printing money. Each scenario carries massive risks for the global economy. Conclusion: time for hard choices. The U.S. debt crisis is a man-made problem, not an act of nature. But solving it will require political leaders to embrace hard choices, choices that are unpopular in the short term but necessary for long-term stability. Ignoring the problem will not make it disappear. Unless the U.S. takes serious steps to control spending, reform entitlements, and responsibly manage its fiscal house, the safe haven status of treasuries and the dollar will not last forever. The time bomb is ticking, and the world is watching. Don't forget to like, comment, and subscribe for more deep dives into global finance, economics, and market trends. Hit the bell so you never miss a new video.